Okay, so what if I told you that you could get paid just for owning a piece of a company? I mean, without ever selling a single share. Sounds pretty great, right? Well, that's the whole idea behind dividend investing. And today, we're going to break down exactly how you can find the best, most reliable dividend stocks for 2025. All right, let's just dive right in.
And really, it's a fundamental question, isn't it? I mean, we're all taught the same thing. Buy low, sell high. That's the mantra. But what if there was another way? What if your stocks could send you a regular paycheck, almost like a salary, just for holding on to them? That's the powerful idea we're going to unpack right now.
All right, so let's start at square one, the absolute basics. This first part is all about figuring out what a dividend even is, and more importantly, the one number you absolutely positively have to know. So that magic number is the dividend yield. You can think of it as your return on investment paid out directly to you in cash. It's kind of like the interest rate you get on a savings account, but for a stock. The math is simple. You just take the company's annual dividend and divide it by the stock price. And trust me, this is the first number every single income investor looks at. Okay, let's put some real numbers to this to make it sink in. Imagine you invest, say, $10,000 into stocks with an average dividend yield of 6%. Well, over the course of a year, that's $600 in cash, just showing up in your account. That's real income you can spend or save or, and this is the exciting part, reinvest to buy even more shares. But, and this is a huge but, this is where smart investing really begins. See, just chasing that big, juicy yield number without understanding what's going on behind the curtain, that is a classic rookie mistake. We have to look deeper, you guys, because sometimes a really high yield isn't a gift, it's a trap. And this is so critical to understand. You might be thinking, wait, why would a high yield be a warning sign? Well, think back to that simple formula. Yield is the dividend divided by the stock price. So what happens if a company gets in trouble and its stock price completely tanks? Mathematically, the yield is going to shoot way up. It might look like an incredible deal on paper, but more often than not, it's a giant red flag that the company is in trouble and is probably about to cut that dividend payment. So, how do we protect ourselves from these traps? Well, we use a simple tool, the 3-point dividend safety check. It's super straightforward. First up, the payout ratio. Basically, what percentage of its profits is the company paying out? If it's like 95%, what's left over for growth or, a rainy day? Not much. Second, dividend history. Does this company have a long, reliable track record of paying and even better, increasing its dividend year after year? And third, debt. We got to look at the debt. Is the company drowning in it? Because if it is, that could definitely threaten future payments. Okay, so now that we've got our safety checklist, let's actually put it to work. This next part is all about learning how to spot the difference. The green flags of a healthy dividend versus the massive red flags of one of those dangerous yield traps. It's really a tale of two stocks. Over on the left, you've got your green flags, a healthy, sustainable dividend. We're talking a moderate yield, a nice low payout ratio that leaves plenty of cash for the company to grow, and a long, consistent history of payments. But then, on the right, you have the yield trap. This is the stuff of nightmares. An unusually high yield that seems too good to be true, a dangerously high payout ratio, maybe a spotty payment history. It's pretty clear, right? Our goal is to live on the left side of this chart. And it's also important to remember that not all dividend stocks are created equal. They come in different flavors. You've got your REITs, that's real estate investment trusts, like Realty Income, which are basically built for steady, often monthly income. Then you have an energy company like Enbridge. They can offer a higher yield, sure, but they're also super sensitive to the price of oil and gas. And then there's a consumer company like Altria, which has this very high yield and a long history, but it's also facing some pretty serious headwinds in its industry. See the difference? That's why spreading your bets, diversifying, across these different types is absolutely key.
All right, we've spent a lot of time on what to look for. So now let's flip it. Let's talk about what to avoid. Honestly, just knowing about these common traps can save you a ton of headaches and a ton of money down the road.
Okay, here are the big ones, the absolute do-nots. First, do not just chase the highest yield you can find without doing your homework. We've been over this. Second, always remember that a crazy high yield might just be a symptom of a crashing stock price. That is a major red flag. Third, don't put all your eggs in one basket. Spreading out across different sectors is so important. And finally, please remember this isn't a set it and forget it kind of deal. You've got to keep an eye on your investments and see how the companies are doing. So we've covered the theory,
we've got our safety checklist, we know the pitfalls to avoid. Now for the big question. How do you actually put this all together and get started? Well, this next part is your blueprint, a clear, actionable plan.
Here it is, your 4-step action plan. Step 1, screen. Use a stock screener online to find companies that actually meet our safety criteria, payout ratio, history, and so on. Step 2, set realistic goals. Aim for a healthy portfolio yield, maybe something in the 3 to 5% range to start, not the biggest number you can find. Step 3, consider reinvesting. This is huge. You can use something called a DRIP, a dividend reinvestment plan, to automatically use your dividend cash to buy more shares. That's how you unlock the incredible power of compounding. And step 4, as we just said, monitor. Keep checking in on the health of the companies you own.
So, if there's one thing you take away from all this, let it be this. Successful dividend investing is not about a treasure hunt for the highest number. It's about finding healthy, strong, durable companies that can consistently share their profits with you, their owner. It's all about safety and sustainability first. So, I'll leave you with this final thought. Now that you have this framework, what's the very first question you're going to ask the next time you see a stock with a tempting dividend?